Yeah, so good afternoon, everyone, and welcome to our monthly webinar. My name is Bhargav Buddhadev. Let me just take you through the portfolio performance for the month of June, starting with Coffee Can. So you can see from this particular slide that in the month of June, coffee can was up about 4.5%. Index, however, was up by about 6.8%. But if you look at from a 6-month perspective, the difference between the index and the portfolio performance is very minuscule. So whilst the portfolio was up 10.8, the index was up about 11.3. The top contributors for the month of June were Zomato with a return of about 12%. HDFC Bank, after a long time, has now come back into action, given that quality seems to be coming back into flavor, especially post the budget with a return of about 10%, and Avenue with a return of about 10%. Amongst the bottom performance were from Havels, -5%, Container Corp, -3%, and Eicher Motor about -1%. Moving on to GNC. So Good and Clean, it was a fairly strong month. And if you look at since the last 1 year, the performance continues to remain fairly healthy. So if you look at for the month, it was up by almost 10%. 6 month, the return has been 18%, and last 1 year, the return has been 45%. So significant improvement in terms of the fund performance in the last 1 year as compared to the 3-year period. If we were to look at the top performers for the month of June, there has been a significant number of stocks which have delivered double-digit returns in the month of June. However, if we were to just talk about the top performers, they were Persistent System with a return of about 25%, Aegis Logistic with a return of about 23%, and Trent obviously continues to remain in flavor with a return of about 20%. Since June, especially post the elections, it seems like that there is a change in terms of the sector allocation. So it seems like companies which are reporting strong earnings growth are coming back into flavor, and hence we see that both GNC as well as EG have been reporting strong numbers, especially in the last 1 month. Amongst the bottom performers were Blue Star, AU Small Finance, and Ajanta Pharma. In fact, Blue Star and AU reported positive returns, 4% and 3% respectively. Ajanta Pharma was the only one with a -2%. We move on to emerging giants. So emerging giants again reported more than 10% returns in line with EG. To be precise, 10.4 for the month. If you were to look at from a 3-month perspective as well, there is now alpha compared to BSE 500. So 3 months, the return has been about 14%. And if you were to talk about the top performers, it was VMart. So VMart, we added post the newsletter which we wrote in the month of February, where we highlighted that one should definitely have a look at the rural theme. And VMart was one of the picks which we got into to play the theme. It was awarded handsomely, and if you look at the month of July also, the reward still continues. The second stock which did well was Home First with a return of about 26%. Seems likely that in the affordable housing space, the government should come up with some good allocation in terms of budgets. So possibly that's the reason why Home First was also doing well, and likewise Sera with a return of about 25%. In terms of bottom performers were Mass and TeamLease with a return of 2% and 1% respectively. and Venus Pipe -3. But if you look at calendar year, obviously it had already rallied about 50 odd percent, and hence some time for a breather as far as the month of June is concerned. Moving on to 10x. 10x also reported a good performance with a return of about 9% for the month. If you look at the 3 month return as well, it's fairly impressive at about 13% compared to 11.7% for the benchmark. In terms of the top performers, in line with the GNC, these names continue to remain the same: Persistent, Aegis Logistic, and Trend. In terms of the draggers, you have AU with a return of about 3%, Aarti with 0%, and Venus Pipe with about 3%. But the most interesting part of the webinar is the note which we've written as a team on the chemical space. We're extremely bullish, and Trilok will take you through the newsletter on the chemical space. Over to you, Trilok.
Hi, good evening, everybody. Thanks, Bhargav, for taking us through the quick snapshot performance. So, on chemicals, we obviously wanted to share our perspective given what we are picking up on ground and what we are seeing in the business. So, we have divided. So, just to refresh memories, I think so. Chemical as a sector itself has been sort of an ignored or a forgotten sector, primarily in the last 2 years, 2.5 years now, particularly what happened post FY22. And we have divided the whole sector into two major cycles. One is a extremely bull cycle, which is FY17 to 22, where the sector itself delivered a 50% CAGR versus mid cap and the Nifty mid cap sort of CAGR of low teens. This obviously mega bull cycle was driven by a major sort of factors. One was very very strong demand, and second was of supply chain challenges, particularly in China, which led to India being a big beneficiary. Over the last 2 years, obviously, we have highlighted in the subsequent sort of slides that why the industry went through the tough phase, and finally, and most importantly, what is the outlook that we see going forward. Moving ahead, when I just spoke about the bull cycle, next slide, please. So I was saying the bull cycle that we saw, particularly the dream run for the sector as a whole. So obviously the spec chem industry grew almost 2x of the in chemical industry. More importantly, when that particular spec chem industry sort of grew very very strongly, also the realizations for a lot of these names that India remains either the probably the second or third supplier globally, or we have a meaningful sort of process or cost sort of advantage over global suppliers. We continue to sort of face significant sort of benefits in that particular era. And FY17 to 22 was also coincided with a significant I would say reallocation of capacities done by China, whether it was related to winter shutdown or with related to the blast that happened in Zhangzhou, which is one of the largest complex of chemicals in the world, or also with respect to the China themselves focusing on moving away from more commoditized chemical to a relatively more value-added chemicals, which is why and if you remember, if you go back to CY11 to 20, China used to feature amongst the top 10 most polluting sort of of the top 10, 7 were featured by Chinese provinces in terms of most polluting sort of cities or states, which I think so they have able to incrementally sort of make some progress out there. However, even in the next decade or so, Chinese focus of sort of moving away from a very very low commoditized product to relatively value added products is absolutely a great news for India in the longer run. So from that bull cycle to moving ahead, we obviously saw a subdued period, and when you say subdued period was driven by 2 3 factors. One, we saw so what happened was supply chain disruption, particularly in FY20 and 21, led to a lot of higher stocking at the dealer distributor level globally, which effectively meant there was an aggregate destocking, which obviously naturally followed, Because if you go back to 21, the supply chain disruption was so massive that even if you sort of had you had no stocks because of global freight rates moving up as sharp as 3 to 5x in a matter of 3 to 6 months time frame, and also your ability to produce a product was dependent on the RM that you were obviously not able to source at the right price. So agchem destocking, rise in feedstock prices thanks to the Russia-Ukraine war which broke out in February 2022, and some impact of the domestic sort of slowdown that we sort of saw in which led to sort of decline in terms of EBITDA as well as the pricing. So barring one or two sectors, most of the sectors, sub-segments within the chemicals, if you look at, witnessed a decline in the FY24 as well. Moving ahead, the subdued period, as I was highlighting, was also a function of one of the most difficult period in global agchem cycles. In fact, as I said, the destocking, particularly led by pricing correction as well, had led to the inventory lowest level in particularly in the last 2 decades or so. And we think if you go back to history, only 2015 was such particular phenomena where Brazil had a massive sort of inventory correction, and plus also a lot of these global agchem companies had very very high channel inventories, which was coupled with Brazilian real depreciation by nearly 40-45% in a matter of quarter, which I think so it's been a very rare phenomenon in the last decade or so. And our global sort of check suggests that inventory destocking has behind, and restocking will obviously only gradually pick up as we speak forward. Moving ahead from subdued period to what's the and why do we think India's competitiveness against the global peers has only got better in the last 3-5 years? I'll give an example. The labor cost in China, has gone up further from $3 to $3.5 as it progressively move forward. Despite adjusting for the productivity, because that's the common perception that the Chinese worker is between 2 to 3x more productive compared to the Indian average worker. But India is clearly a capital of from a total number of chemistry and total number of R&D specialists in this particular sector that they deploy. So we believe structurally India fares better in terms of both material cost and margin efficiency, thanks to process and the product improvement that we continuously bring on the table. And we our cost operating it at all levels continues to get better and better compared to any other sort of regions, including China, Vietnam, and so on and so forth. So competitiveness have gained further traction as we speak ahead. And India's focus on import substitution and also being a significant supplier to China plus one and Europe plus one strategy will mean incrementally we are going to get meaningfully better visibility in terms of growth rates, and the spec chem industry, in absence of price fluctuation, could get better and better moving forward. Moving ahead, what we think, and what are the key signs of green shoot visible? I think so. Two, three important sort of. So we have obviously put across a lot of the feedback that we and the important sort of outlook that the global agchem and the chemical majors have put out. So right from largest chemical manufacturing company to largest agchem company to one of the largest specialty chemical company, everybody has spoken about outlook getting better compared to CY23. And more importantly, volume recovery continues to surprise positively, particularly in the Europe markets. And pricing that we saw in October, November, December as one of the lows, is obviously started to witness to improve as we move when we move forward to the next slide. When you and this is exactly what we wanted to highlight here again. These are just examples of couple of names that we are trying to showcase to you. The prices have sort of moved up dramatically in the last since the last few months, and in particularly from the Q2 Q3 averages, we have seen the movement is as sharp as 60 to 70% of the lows. And more importantly, the prices that were in Q2 Q3, we believe and understand from the global, sort of manufacturers that in some cases they were at below, 2 decades and 15 years average, and they would have even not made cash cost of production. Forget about making any margins on those prices. So A, it was not sustainable, and B, in our opinion, would have led to meaningful, capacity shutdown globally if those prices had sustained for a long period of time. So, moving ahead, I think so. The point we are trying to highlight here in summary is what is A, the price, the inventory restocking is over. B, the prices have started to witness to show improvement going forward. And C, volume continues to remain sort of, in mid single digit, particularly in the developed markets, and India is only participating further. So, all these 3 points highlight that, and most important, there is no meaningful overcapacities coming up the next 12 to 18 months time frame for the, for the balance to sort of disrupt or an imbalance to create in this sector as a whole. So we will obviously have our, select we have allocated more capital to this sector, both in emerging giants and GNC and 10X, as we believe we are poised for a meaningful, better, run and outlook for both in terms of earnings as well as stock prices going forward. And this is the time to sort of push the pedal in order to benefit from this particular outlook in the recovery that we are witnessing. With that, I will probably just quickly take you guys through the macro and update that we are looking at economy. So one clear perspective that we are building up is, we think with this particular NDA 3.0, the government that we are obviously sitting at, a rural has been unfortunately an ignored, I would say, segment by this particular government in the last decade or so, which we believe obviously will take a take a change of stance moving forward. As you can see, the government capex, particularly in the rural spends, have obviously down by 100 basis points, but the capex has also doubled in the last 5 7 years in particularly. We think a obviously thanks to the drop in the seat share that you see right on the chart, obviously will give them a alarming or a wake up sign. And B, obviously the rural recovery is also very critical from an economic sustenance point of view, because we cannot see have a urban economy doing well and rural continue to suffer, because that's not how you will end up want the economic sort of progress to happen. So we think direct rural schemes will have a higher allocation in the upcoming budget. Although we are not taking away the fact that capex could obviously also continue, but obviously capex we believe will be growing at a lower pace compared to the last 3 year 4 year averages. But certainly rural will not be ignored, and which is why as Bhargav alluded, that we had taken opportunities and added in our portfolios rural recovery themes, and we think that will on the the situation or the noise could get even louder as we progressively move to H2. Moving ahead from what expectations from the rural to what one of the important point that we are all focusing on, the monsoon recovery has been quite stupendous. Until last week we were at 16 to 17% deficit. The last week obviously has seen a massive rainfall, and now we are at 2% above long term averages, which is again a great news, both from a rural recovery point of view, and B, from a sowing point of view, because mid July to first week of July is a season where farmers tend to sow the seeds for the upcoming season. And we think a good catch up in the last 7 8 10 days in the monsoon will only give a very very strong outlook for the crop sowing season to begin with. Moving ahead from monsoons to earnings, we think the Q1 earnings season will obviously be a little soft than what we saw in the last quarter, primarily a function of margin sort of coming off. So we obviously witnessed a very very strong end to a Q4 in FY24 margins. We think a profit growth will obviously taper off to single digit in this quarter, and again earnings will be driven by BFSI and auto, while the metal contribution and healthcare could rise. There could be obviously within the subsectors uh, oil and gas and IT could be a draggers from a contribution point of view. So that's broadly on earnings expectation. Moving ahead, and finally on the valuation front, obviously markets have moved lately In certain pockets, we have seen some signs of valuation a little longer than long-term averages. But on the Nifty front, we are still seeing markets at long-term averages. And on a price to book front, obviously the valuations is at 18-20% premium, but that's, in our opinion, reasonably justified given the fact that the ROE of the Nifty companies are also at a decade high, and we are obviously will clock. In our opinion, FY25 we will probably end up at 16.5, 17% ROE compared to the 14% for the last decade or so. So ROE price to book should also be looked in conjunction to what kind of capital efficiency those businesses or those companies are generating. With that, I think so. I will conclude the call, and I will